Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azuz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. On this episode of the podcast, I have a special guest, Jeffrey Kleintop, Chief Global Investment Strategist at Charles Schwab, who I'm very excited to speak with. Jeff is someone we follow closely at Heritage and have a tremendous amount of respect for, and our clients have enjoyed his insights over the years as well. Welcome to Wealthy Behavior, Jeff. Thanks for doing this.
My pleasure. Thanks for having me on. We've often spent a good bit of time together in the past, so looking forward to doing this podcast with you.
Absolutely. Thanks. So just to set this up, what is the role of a Chief Global Investment Strategist at Charles Schwab?
Yeah, great question. So I'm charged with figuring out just, what's going on in the whole world. And then what it means for us as investors, primarily US-based investors, but we do have customers around the world. And so trying to figure out, what are the global economic and earnings trends? What are the geopolitical factors that may affect the markets? What are, the other issues going on that may either entail greater risk in portfolios or rewards, and then figuring out how to position to either protect from some of those things or profit from them. So just trying to help people be more confident in making their own investment decisions.
And in that role, are you more focused on the international markets, or is it all global markets, including the US equally?
Well, it certainly includes the U.S., but Liz Ann Saunders covers the U.S. in much greater detail for us. She's our U.S. strategist, so it's part of my purview. But really, I'm gonna leave that to her, and I'm gonna kind of cover the rest of the world and what it means, not just in terms of its influence on the U.S., but in terms of just from a global investing perspective.
Great. So that'll be our focus today. So as part of this role, I know you talk to a lot of retail, institutional investors, wealth management firms like ours who are managing money for folks. What would you say is the sentiment right now? What are some of the biggest questions you're getting?
I think investors are encouraged by what they're seeing in the markets this year, feeling that maybe we avoided a downturn in the U.S., although we did certainly see a recession in a number of countries around the world, and that maybe we're moving towards rate cuts, and that might mean some relief on the interest rate front. So some optimism, but at the same time concern about a number of geopolitical events taking place around the world, concern about the narrow leadership of the U.S. stock market here with the Magnificent Seven, AI-related stocks really pulling away from the rest of the pack. Does that signal widening risk in the markets? And then, of course, there are election concerns as well. What does the future look like in terms of policy? Not only here, but there are many elections around the world. In fact, most of the world's citizens are going to be voting and going to the polls sometime in 2024. So all of that factoring into a number of concerns that sit very close to the optimism that investors have been displaying so far this year. But you've got to like a year that's at least off to a good start here. We're up across the world's markets, 5, 6, 7, 8, 9, 10. Gosh, Japan up nearly 20% this year. So pretty bullish start to the year.
How do you think about geopolitical events and elections? People, I think, and I don't want to predetermine your answer, but I think people tend to overweight them in terms of concerns for their portfolios. A lot of times, maybe they turn out to be blips and causes of short-term volatility. But am I wrong, or how do you think about, or how do you counsel investors to think about the geopolitical risks that we see all the time?
Yeah, you've got so much time and experience in the industry. You know that that's the case. And so what we've generally seen is that markets and economics tend to have a bigger impact on politics than the other way around.
Interesting.
Right. I mean, certainly, we've seen that here. In fact, looking at some of the elections this year, we're seeing, a drift towards concern about the economic backdrop and the inflation backdrop that's lingered over the last couple of years and how that's impact election campaigns. And so generally that's the case. But there are times when political developments do have an impact on markets. They're rarer than the other way around, but they do happen. And so looking around the world, I think that one of the things that's shaping up this year, maybe a takeaway from this year's elections, and again, voters in 80 different nations and territories representing more than half the world's population are expected to vote this year. So I'm not just talking about the US election, although it applies there as well. What we're seeing is a broad theme begin to emerge. The potential for outcomes that encourage nationalist policies, potentially hindering trade in manufacturing goods. So markets could respond negatively to an outlook for rising tariffs and trade frictions that could boost inflation, maybe again, and weigh on exports. Now, we've heard this before, trade war, right? And it really didn't pan out that way. We certainly didn't see a huge surge in inflation in 2018 or 19. In fact, it continued lower despite all those Trump tariffs. And certainly as Biden's continued some of those and even added to them, they weren't really the main drivers of the inflation or the weakness in economic growth here over the last couple of years. So we have to take that with a grain of salt. But still, the sweeping elections around the world do tend to point towards the potential for more of a my country first approach around the world. And what that could mean for manufacturing exports and inflation is something we'll keep a close eye on this year.
And you are seeing a shift in global manufacturing.
Yeah, I'm really excited about this. So I've talked about this year as a or the last year, let's say 12 to 16 months, as a cardboard box recession. Let me step back for a second. Time Magazine's 2023 Person of the Year was also the world economy's most valuable person of the year. Yep, I'm talking about Taylor Swift. The last year was a cardboard box recession due to the downturn concentrated in manufacturing and trade, things that go in a box. But I could have just as easily called it a Taylor Swift expansion. There's been an amazing and unusual divergence between weak manufacturing activity measured by demand for cardboard boxes and the products that go in them, and strong demand for live concerts, as all us Swifties know. It was global. In fact, in Japan and Australia, where Taylor Swift's tours this over this past month, they saw the biggest year for tourism spending in over really ever in 2023. So, of course, it was broader than just concerts. It was travel and entertainment in general. But now, after a boom in entertainment and a slump in factory output, both seem to be converging in 2024 as things get underway. In February, the Global Purchasing Managers Index, that is my favorite piece of global economic data, the PMI. If I'm on a desert island, that's the one thing I want to know what's going on in the world. And that showed us that manufacturing ticked up to 50.3. The dividing line between recession and growth is 50.0. 50.3, just above 50.0 for the first time in 18 months. So we're just starting to see signs of this cardboard box recovery, I'll call it, getting underway. And maybe the post-lockdown travel and entertainment boom has finally run its course. And that could mean a shift in economic and earnings momentum to manufacturing businesses and to countries that do a lot of manufacturing and exporting, like Japan, like Germany, like the UK, which all suffered recessions late last year.
Is that shift in global manufacturing partly due to countries reassessing their supply chains because of the issues they felt during COVID, or is that a separate topic?
I guess there are things that are related to it. Certainly, there is more domestic manufacturing production beginning to start up in a number of industries that are deemed essential, like semiconductors or even personal protection equipment that was so important during the pandemic. But that's really a minority of that's like 3% of global manufacturing. We're really seeing, broadly speaking, inventories just finally came down. You know, people shopped from home a lot during the pandemic, and so manufactured goods were in demand, and no one can travel. So services were in a recession, and now we've seen the flip side of that. People are saying, I got enough stuff, I want to go travel again, and so they did that. Now we're seeing demand for manufactured goods come back again. And that's helpful in a number of different ways, because a lot of the earnings that we're seeing in the major stock market indexes are tied to manufacturing. There are a lot of services industries like healthcare, for example, that don't really show up. Sure, we have drug companies in our indices, but we don't have doctors, right? And so a lot of what we see in terms of spending on manufactured goods really does go right into earnings for those major indexes. And that's why it's encouraging when we start to see that turnaround. It also tends to mean good things for earnings as well.
Okay, great. No, I appreciate you clarifying that. So historically, US and international stocks take turns outperforming, right? But we've been in a very long stretch of US outperformance in an environment where really a lot of third-party capital market assumptions that we look at had predicted weaker returns for the US looking back over the last decade and premium, returns overseas. Why do you think the US has outperformed so much? And do you think there's a catalyst for a change there going forward?
So I do think there's a catalyst. I think we've experienced it. We're starting to see new international leadership begin to pick up. But you have noted that they do take turns. And absolutely true. What I found is that every economic cycle, we get different leadership. In the 1980s, it was all about international investing, and Japan was the place to be. And in the 90s, well, it was all about tech stocks and the dot-com bubble, and the US did really well. And then that early 2000 cycle from 2001 to 2008, international once again outperformed. The BRICS did really well, of course, emerging market stocks, and Europe did very well also, led by financial stocks during that financial bubble, right? And then, of course, we went through the 08-09 recession, started the cycle from 2009 to, well, wherever we've just been here recently, and that was really led by the US. So we have seen this reversal led by behavioral as much as fundamental reasons. Now I think we've started a new cycle of international leadership. So you may say, well, wait a second. If we look at the indexes, that doesn't appear to be the case. The S&P 500 has outpaced the rest of the world. And the reason for that, I think, is the capitalization weight of that index. So much is concentrated in just a handful of AI-related stocks that have done really well, right? We've just been in this incredible boom since ChatGPT launched about a year and a half ago, the 3.5 version. We've really seen AI stocks really take off. So what I'm seeing here is that as the global economy transitions to this new cycle, markets are experiencing new leadership. We had forecast that for the first time, European stocks would lead US stocks last year. They actually did. Europe's stocks 50 index outperformed the S&P 500 index, measured in dollars or euros. And that's true again this year, along with Japan's Nikkei 225 is outperforming. In fact, the performance gap last year was wider on an equal weighted basis. This is really what I'm focused on here. Since the bear market ended in October of 2022, the average international stock has outperformed the average US stock by 10 percentage points. And we can see this in those equal weighted indexes, the EFI index and the equal weighted S&P 500 index. Now, because we tend to track markets using the capitalization weighted indexes, where the biggest stocks get the biggest weight, the leadership by those magnificent seven stocks has resulted in the capitalization weighted outperformance by the US. But that's rare historically. Usually equal and cap-weighted indexes tend to trend in the same direction for relative performance. And I think that broader outperformance by international stocks offers more support than the US's narrow leadership going forward. So I'm really encouraged by what I'm seeing, particularly in some of those key international markets. Japan is the largest country in the EFI index, 23% of that index, up 18% this year. I think that's a real sign that we have turned the corner on relative market leadership. And we're going to continue to see that broaden here over the course of this cycle.
Okay, great. Thank you for that outlook. And those markets you talked about are developed international markets. We talked about the US. We did touch on the emerging markets. What are you seeing there? And do you see a catalyst for them joining the party?
That's a much tougher assessment. So when we tend to think about emerging markets, we tend to think about China because China historically is dominated. Boy, if you look just a few years ago, China was about 50% of the emerging market index. So whatever China did, the whole emerging market universe it just drove everything. Now, China's only 22% of the emerging market index. India, in contrast, is 18. India's gone from 8 to 18 over the last few years. And I think by the end of this year, India could surpass China in that index. Very different backdrops between the two countries. India's economy is booming, doing incredibly well and picking up share of manufacturing activity. The economy is growing 6-7% this year, last year, probably next year. Contrast that to China, which is slowing down, has chronic problems here in its property market that they just did not address at this latest National People's Congress just this past week. Its stocks in China have suffered a very long, prolonged bear market and are valuations there at 20-year lows. Valuations in India, 20-year highs. So you've got these two very different economies on very different trajectories with very different valuations now, kind of balancing out that emerging market outlook. So if it was all just concentrated in China, I'd be a bit more concerned and say, I just don't see China doing enough to turn around its economic momentum and uncoiling that spring of low valuations. But I'm kind of excited by what I'm seeing there with India, although recognizing that any stumbles by India, including maybe in this election here in India coming up in May, you could see something coming out of that that questions the ability to deliver some of the policy proposals that have been put forth, and so that could cause valuations to pull back. Anyway, the point is, I'm not recommending an overweight or an underweight to emerging markets. I think because those two are balanced within that universe, I think it's an interesting thing to watch. And with the manufacturing recovery, perhaps meaning more commodities demand picking up, that really helps Latin America and the Middle East, which is also part of that index. So a little bit more optimistic on emerging markets this year than I was last year, but still not recommending investors take an overweight position right now.
An overweight position. So touching on that, staying on the topic of asset allocation, investors have historically had a home country bias when allocating their investments. Can you explain this concept and what would be your starting point for a stock allocation as a US investor?
That's my favorite topic. So, when I look at markets around the world, generally what I find, and this is true as I travel as well, I find that investors tend to concentrate their portfolio in the market where they live. And it makes a lot of sense. Here in the US, the average US investor, without the benefit of guidance like yours, tends to put 75–80% of their portfolio in US stocks, of their equity portfolio. But that's true when I go to London, and they're in 80% UK stocks. It's true when I go to Japan, 80% Japanese stocks. It's true when I go to Greece, 80% of their money in Greek stocks. This is not a good idea, but tend to be what people do. They're more comfortable with the companies that are local. They kind of know them a little bit better. Maybe they don't love the politics, but they know the politics better. The economy they're more familiar with. It feels safer to invest closer to home. But there are consequences to this with markets that tend to behave in a certain way. The Japanese stock market tends to behave like a financials index. Germany tends to behave like an auto ETF. The US tends to behave like a tech ETF. Sometimes that's great, like over the last 10 years. Sometimes it's not so great, like in the early 2000s. And so you get that concentration risk in your portfolio that you don't need to have if you're more broadly diversified. I'll give you an example. One of the biggest stocks in Europe is Nestle. It was the biggest, but now I think Novo Nordisk has taken over. Nestle compares to Coca-Cola. They both sell beverages and snacks to pretty much the same global footprint of customers around the world. They have almost the same distribution of sales by country and continent as each other. So obviously they're different products, but essentially beverages and snacks sold by Coca-Cola and Nestle. Their revenue growth and their earnings growth is almost exactly the same. I think the forecast this year, and this isn't a recommendation for either company, but just as an example, 4% earnings growth expected this year for Coca-Cola, 4% for Nestle. So you're really getting the same earnings growth, but Coke trades at a 3 PE point premium to Nestle. It's just a more expensive stock. Now, why would you pay more for a company that's delivering exactly the same earnings for pretty much the same products to pretty much the same people? It's not like, Europe is growing fast or the US is growing faster than Switzerland, so you'd value that differently. It's the same customers, right? So the difference is the investor base. The 80% of the investor base of Coca-Cola that's located in the US are just more optimistic about the future than those in Europe, which are suffering with a war, just suffered through a recession last year. They're just more pessimistic in terms of their outlook. So they're valuing those companies differently, even though those companies are delivering very similar results. So that isn't always the case that Nestle trades at a discount to Coke, but it is now. And so I think that's an opportunity. When you look around the world, we're really talking about global companies here, right? We're talking about Toyota and Nestle and Sony and just major companies around the world. These aren't companies we typically think of as belonging to one country. And right now they're trading at a very substantial discount to the US. In fact, the international index, the EFI index, is trading at a 15% discount to its 10-year price to earnings ratio average. The US is trading at a 30% premium. So all these US companies in the same industries as their international counterparts are trading at a much higher premium for very similar earnings outlook. And that's why I see a very, very interesting opportunity right now, and why I think investors are maybe wrong or to be overlooking this opportunity to go beyond their home bias.
Do you think investors should overweight specific regions or country or avoid certain regions or countries, or is trying to have something close to global stock market exposure more appropriate?
I think the global stock market exposure is more appropriate. In fact, you had asked me, I didn't answer what the right weighting was. I think, generally speaking, the answer I'm giving to most people is, what's the right weighting? It's probably more than you have right now. And that's because after a decade plus of US outperformance, maybe the average investor hasn't rebalanced back in international to get back to that longer term allocation target. I think when an asset class is out of favor, as international investing was in the 2010s, then you'd want to be very focused if you're investing outside the US, picking a particular industry or country outside the US to focus on because of a unique opportunity there. And there were some. Now, I don't think you need to do that. We're seeing broad outperformance. Again, the equal weighted benchmarks internationally are outperforming. So the average international stock is outperforming the average US stock for the last year and a half. And so you don't need to be as specific. You can have broad global diversification, looking to broad international indexes to balance out that US exposure in your portfolio. And you don't have to be as selective in picking a country or an industry outside the US as you might have had to have been in the 2010s.
Okay, great. I appreciate that, Jeff. You shared recently that the US dollar is structurally overvalued compared to some other developed market currencies, and that this could be potentially good news for US investors if they're invested in non-US assets. Could you explain what that means and why it would be a good thing?
Sure. Well, the dollar tends to move in cycles, and so we believe we're nearing a period where the dollar might be a bit weaker, not necessarily collapsing or giving up its status as the world's reserve currency, but fading a little bit in terms of its valuation, maybe a 2 or 3% a year over the next several years. And the benefit to a U.S.-based investor when the dollar falls is if they're investing in foreign assets, foreign stocks or bonds, those gains in euros or yen translate back into more dollars as the dollar goes down, right? And so that's an addition to your return. So if the dollar's going down 2 or 3% a year, well, that's another 2 or 3% added to those gains in terms of how they're measured in your portfolio and on your statement. So that's good news. It tends to be a long period. Dollars tends to move in long cycles. So obviously there's volatility on a day-to-day or month-to-month basis, but generally speaking, we're looking for the yen to appreciate here. The Bank of Japan may hike rates. Hike rates. I know we're talking about cutting rates everywhere, but may actually hike rates for the first time in 17 years this month. If they do, that should strengthen their currency relative to the dollar. In fact, we're already starting to see that here over the last day or two, and again this morning. And so if that's the case, then those gains in yen translate back into more dollars in your portfolio and help to boost your returns.
So we touched a lot on our podcast about what is going on with US central bank, the Fed, rate hikes here in the US, the economy, the inflation battle. But we haven't focused as much on what is going on with central banks internationally and, economies overseas, the inflation fight overseas. You touched on Japan maybe hiking rates, but what should US investors know about what central banks outside of the Fed are doing and what inflation looks like overseas?
Well, fortunately, it's pretty similar to what the Fed is set to do. So most of the world's central banks are set to begin cutting rates this summer. So they all tended to move generally about the same time on the upside, and now they're all beginning to shift to cutting rates at about the same time. June seems to be the start rate for the Fed, probably the start rate for the European Central Bank. Maybe we'll see the Bank of England start around then, maybe a little bit later, the Bank of Canada as well. So all the world's major central banks are kind of lined up, but it's not an upside down V, meaning that don't expect rate cuts to come down as fast as they went up. So we're looking at maybe 3 or 4 rate cuts this year by the Fed, maybe 4 or 5 for the European Central Bank, again, starting in June and then following every meeting after that at about a 25 basis point pace. So rates are going to be a little bit longer or higher for a little bit longer. They're not immediately going to be cut right back down to zero again. And so I think that's it's more of a modest change in interest rates for the world relative to maybe the jarring moves we've seen in recent years around the rapid rate cuts in response to the pandemic and then the surge back up again. More of a mild environment for global central banks, but one where they're all kind of moving in that direction. And we've already started to see some of the emerging market central banks lead the way. Peru and a number of other countries, excuse me, which led on the upside, are now leading on the downside as well. They've been cutting, I think maybe maybe some of them started in August, September of last year. So they're already leading the way. And that's one of the reasons why emerging market currencies have actually held up really well relative to the dollar this time. We think of the strength of the dollar versus the euro and the yen. That's actually only really held its ground versus emerging market currencies. And now they are on the path towards cutting. Rates are still much higher in many emerging market countries, but they're coming down even more rapidly. And that should be good news for many of those economies that have suffered through not only a Chinese economic downturn, but a downturn in manufacturing as well. So that could be supportive for those countries as we look forward.
I appreciate that, Jeff. I'd be remiss if I didn't ask you about the two global conflicts that we have right now, obviously, in Ukraine and Gaza. Are they impacting markets? Are they impacting global economies? How should investors process the financial implications? Obviously, the human implications are horrible.
Right. I mean, yeah, the humanitarian impact is impossible to measure and devastating. But when we take a look at what geopolitical events tend to mean for the markets, they tend to be short-lived in terms of their impact. And again, that's kind of what we've seen this time. Generally, geopolitical risks are ever present, but when they flare up from time to time, particularly in the Middle East, we tend to feel them through risk to oil prices. And we did see that with Russia's invasion of Ukraine. We did see a spike up in energy costs. They came back down again. And, obviously an escalation of that conflict could maybe push energy prices back up again, but we're not seeing a sustained rise in energy as a result of that conflict. The energy supplies have been redistributed around the world. And as a result, that's very much moderated. I'm looking at oil prices right now on my screen, about $78 a barrel here for West Texas Intermediate, which is about where it was before the conflict began. As we think about the conflict in Israel, Gaza, that has resulted in the rerouting of shipping. And this has had an interesting impact. So we had a problem with the Panama Canal beginning late last year, tied to weather. The Panama Canal is ships move through using fresh water, and there have been a drought tied to El Nino. And so the number of ships going through the Panama Canal went down from about 50 to 17 in February. So a real choke point there for moving ships. Ships had to go around South America, added about 20 days to their journey and quite a bit of cost. So that was one major global kind of shortcut that had been blocked up that was creating some potential shipping problems. And then we had the Suez Canal issue, right? Because the Houthi rebels, supported by Iran, are reacting to this conflict in Gaza, and they have been attacking ships coming through the Gulf of Aden and into the Red Sea on their way to the Suez Canal. And that's forced ships from Asia to go around Africa to get to Europe or to get to the east coast of the US, which has added significantly to their time. Right now, that's meant containers, empty containers, those big metal boxes on container ships, have had trouble getting back to China. Empty containers getting back to get refilled. There's about an 800,000 container unit shortage in China as they've gotten back from the Lunar New Year. They haven't been able to ship out as much. And so there's a little bit of a short-term supply chain gap going on right now and an increase in cost to ship that seems to be easing here as I look at some of the indicators, and that should be easing as we get to the end of this month and into April. But it's been a factor. So generally we see higher energy costs and now tied to shipping as well as a direct consequence of these conflicts. That's how we're seeing them affect the global economy right now. Not enough to offset the overall decline in inflation, but certainly transport costs, which make up about 1% of the cost of goods around the world. We're going to watch that very closely because if we did see a more lengthened conflict, a more lengthy challenge to these short global shortcuts, it could begin to pile up and cause transportation costs to rise more significantly and maybe reverse some of the declines in inflation. So we'll continue to keep a close eye on that.
Great. Thank you for that overview. Anything else as we wrap up that you're looking at or you find compelling enough to share with our listeners related to, either global economics or the markets?
We've covered a lot of ground here. I think, as I look out to this year, I am I am excited about the opportunity for for investors in international markets to finally experience some gains here again. I think it's been sort of a stealth rally because we've only seen in the equal weighted indexes, the average international stock is outperforming. Those magnificent seven stocks have done so well, but perhaps we're starting to see maybe a little bit of a faltering there, maybe a broadening of the U.S. stock market and global markets as well. And so I always feel better when we see more stocks driving the markets higher than just a narrower and narrower group of those. So I'm encouraged by some of those trends toward a broader outlook for performance. And so I think those investor fears about a very narrowly led stock market hopefully will begin to fade as we get broader market performance both here and abroad. And that should support portfolios this year, a year that obviously is going to be full of a number of risks and concerns, but one that includes a global backdrop of recovery. I mentioned the cardboard box recovery, but manufacturing picking back up again, kind of pulling its weight, earnings beginning to move higher. So a lot of factors coming together to suggest that this year overall, a positive one for investors.
That's great. So the last question for me, because it was just spurred by something you said, is there a reason why this AI-driven tech rally is primarily benefiting U.S. companies and the rest of the world doesn't have competitors to kind of quote unquote our Magnificent Seven?
Yeah, there are a few different reasons. So the U.S. stocks are on top of that trend because they've developed a lot of the technology and a lot of the solutions. But what's interesting is, TSMC, based in Taiwan, is the one who so NVIDIA gets a lot of attention as the darling and their graphics chips as the darling of the AI world. Well, NVIDIA doesn't make its chips. TSMC makes chips for NVIDIA, right? And so that's TSMC, the biggest stock in the emerging market index.
That's Taiwan Semiconductor. Sorry.
That is Taiwan Semiconductor Manufacturing Corporation, correct? Based in Taiwan. And the TSMC gets the equipment to make those chips from ASML, which is a semiconductor capital equipment making company in the Netherlands, in Europe, which is one of the biggest stocks in the EFI index. So it's interesting to see those stocks, however, not done nearly as well as NVIDIA, though they supply NVIDIA with everything that it does. So it's just kind of interesting to see, again, a different investor base and different enthusiasm around trends in the markets. A US-based investor, much more enthusiastic about the prospects for NVIDIA, even though those pretty much hold the same for TSMC and ASML, though those investor bases in Europe and Japan just don't tend to get as enthusiastic about valuations and future performance as US investors do.
Great. Well, thank you very much, Jeff, for your insight today. As I shared, it's always a treat when we get to talk to you, and I appreciate you taking the time and your generosity.
My pleasure. Thanks for having me on.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakamis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.